Stocks in the communication services sector include industry leaders like Alphabet, Facebook, and Netflix. For bold trades on this sector in either direction, trade daily 3x leveraged ETFs from Direction, TAWK for bulls, and MUTE for bears. Trade boldly. Daily 3x leveraged ETFs from Direction. Before investing, carefully consider a fund's investment objectives, risks, charges, and expenses contained in the prospectus available at directioninvestments.com. Read it carefully.
Are you ready to build, grow, and protect your investments? Welcome to the Index Investing Show, where we give you the tips, tools, and philosophy for reaching your financial goals. And now, your host, inventor of the Portfolio Report Card and author, Ron DeLegge.
All right, welcome to the program. Coming up on today's show, we're going to be talking with David Massa at Direction Investments about many topics. One of them, relative weight indexing and ETFs that use that strategy, what it is and how it works. If you'd like to join us to talk about any particular investment strategy, a particular stock, mutual fund, ETF, 800-516-1220 is the number. We're here. So taking a look at market action from this past, actually we're going to look at it not on this past week, but just look at it since the start of the year, because that's a real big picture view. Now, despite the sell-off from this past week, S&P 500 falling just about 2%, a little over 2%. Total U.S. stock market still ahead by a nudge over 16%. SCHB is the ETF that follows that area. We've got the total U.S. bond market up just a nudge over 3%, BND. We've got the global real estate market, ETF, REET, ahead by 14.5%. International and emerging market stocks are up between 9 to 11%. And then commodities, ticker symbol USCI, down about 0.5%. So there you have it, your big picture asset class viewpoint of what's going on globally. And you can see very clearly that U.S. stocks continue to lead, while bonds and commodities continue to lag. So we'll take a look at what some of the industry sector ETFs are doing and take a look at underneath the hood, because really when we start to dissect the market and look at it from a underneath the hood perspective, we begin to really see which industry groups are driving the market higher. Also, we see which ones are lagging. So stay tuned for that. Now, something else I want to share with you real quick here, and I think it's important. One of the things that we try to do besides give you an investment philosophy that puts your financial interests first, and for those of you new to the program that have not read my manifesto, you can do that at indexshow.com. That's kind of a summarization of what I stand for and what I believe in. And one of the investment philosophies that I give you, it's a 3-word philosophy. I mean, how much easier, how much more simple can I make it for you? Build your portfolio, grow it, and protect it. There's your 3-word investment philosophy. Is that hard to remember? Hopefully not. Build, grow, protect. A 3-word investment philosophy. Now, in addition to having an investment philosophy that puts your financial interests first, I think it's important to also be realistic. Of course, the thing here is we exist in a world, obviously, with very big expectations, and it has led to an exaggerated environment of people with unrealistic expectations about the future. This can be due to irrational assessments of a person's self or others. For example, some are quick to overestimate their own ability to deliver market-beating results. Others assign unrealistic expectations on professional money managers by incorrectly assuming the strong historical results that these managers have achieved will repeat indefinitely into the future. False assumptions trick some investors into projecting and expecting unrealistic performance returns. Back-tested software results might make you feel good, but future results are likely to be radically different. Avoid being tempted by backwards-looking data. Other investors are so infatuated with devising the perfect investment plan or formula that they get victimized by analysis paralysis. When and if the perfect plan ever arrives, they don't recognize it. Moreover, the end result is nothing gets started, nothing gets implemented. Others are plagued by what we called, or what I referred to earlier, analysis paralysis, and the unrealistic view that they'll encounter a perfect investment plan that will be the solution to all their problems. It's been said that the greatest enemy of a good plan is the dream of a perfect plan. More often than not, those who pursue a perfect plan never encounter it, and if they do, they don't implement it because they don't immediately recognize it at first sight. Likewise, the belief that one big winning trade, or one big investment, one big home run is going to lead you to the Holy Grail, well, that's incorrect. Superior results are not caused by one thing, but a multiplicity of things properly executed. Let me repeat that because that's pretty important. For those of you trying to hit a home run, for those of us trying to make it hit the jackpot with that one big winning trade, that one big investment, and I'm going to tell you about one of these individuals on our Twitter feed, but they're basically putting all of their eggs, so to speak, in one basket on one thing. And let me just repeat it because I think it's so crucial for you to understand this. Drill it into your head. Superior results are not caused by one thing, but a multiplicity of things properly executed. Now, on our Twitter feed, this is a story from Bloomberg about a one-trick pony. Those of you wondering if the one-trick pony species has gone extinct, well, I can tell you it has not. It has not because on Bloomberg, they've got a story, and I've got a link to it at Index Show on our Twitter feed, about a short seller who has bet all of his money, bet the entire house, on a spectacular market crash. His name is Russell Clark, and currently he's in a high-stakes short. He's betting that the market's going to crash, and he's got everything riding on it. Now, this guy's a hedge fund manager, and he's got about $600 million under management, according to the story. And he has not performed well over the past several years. And now clients have been fleeing, but instead of adjusting to market conditions, instead of adjusting his point of view, instead of embracing current market conditions, well, he's doubling down. He's doubling down, and he is convinced that the market is going to crash. It's going to be imminent. And, of course, anything can happen, right? We don't know. He could turn out to be right. But the point is he doesn't have of what's going on. Because, you know what? More likely than not, he's going to lose his tail, as he already has the past couple of years. And clients are fleeing. But what I'm trying to help you understand is this quality, this habit of being realistic. Being realistic, by the way, also means not being a sucker for so-called magic formula investing. Speaking from his experience, investing great Charlie Munger, he said this about magic formula investing. There have been several books written by about that. But here's what Charlie Munger said when he was asked about what his magic formula for investing is. He said, quote, "I can't reduce investing to a formula. If you want a formula, you should go back to graduate school. They'll give you lots of formulas that don't work." End of quote. So when we come back, I want to share with you what the investor should do, what you and I should do in order to cultivate a realistic viewpoint of not just the market, but also ourselves and our own investment plan. 800-516-1220. You're listening to the Index Investing Show. We're here if you'd like to join us. We'll share a couple more stories with you on our Twitter feed, which is at Index Show. Coming up a little bit later, David Mazza will be joining us. He's with Direction Investments. We'll be talking about some of the top performing exchange traded funds in the marketplace, what's been working, what's also been happening with regard to a relatively new indexing strategy called relative weight indexing. So I'm going to explain that to you on the show. And we're here. If you'd like to join us again, 800-516-1220. I'll be right back.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
All right, so continuing our discussion of being realistic and cultivating this habit. So what should the investor do? What should we be doing in order to cultivate a realistic perspective? And so here's number one, realize that undue emphasis on short-term events can damage long-term performance. Understand that having a good plan, even if it's not 100% perfect, is better than having no plan at all. Making adjustments to realistic goals instead of abandoning them is an important step. Also recognize that unattainable goals should be deserted since they were inappropriate to begin with. Be aware that even the best investors make mistakes, and so will you. Acknowledge that an investment portfolio unable to provide satisfactory performance during favorable markets is not likely to deliver satisfactory performance during unfavorable markets. So these are all the things that will help you to cultivate the habit of being realistic. To that last point about investment performance, providing satisfactory performance during favorable markets, if your investments right now are having trouble, are struggling, are lagging, are unable to deliver the type of results that you're looking for, don't for a second think that markets that become unfavorable or start to go down, don't think for a second that all of a sudden you're going to start outperforming. That all of a sudden you're miraculously going to come out of the gates and start hitting your targets. So these are things that you need to be aware of. If you'd like me to analyze and grade your investment portfolio and get a diagnosis of where you're at right now, how you do in terms of performance, risk, diversification, taxes, and cost, go to portfolioreportcard.com. So the world's largest investment or wealth managers, where are they putting their money? Well, according to a recent survey that was released on May 7th, 32% of them, 32% of high net worth portfolios are in cash. This is from a survey in Asia and Latin America, as well as Europe. So pretty amazing when you think about it. 32% of high net worth portfolios are in cash. Well, here's the thing to remember about cash. Cash resists shock, but is not completely anti-fragile because it does not gain or grow from chaos. Keep that in mind. Those of you stockpiling and hoarding cash. Cash is not anti-fragile. Why? Because it doesn't benefit from chaos. You want to benefit from chaos? You want to have exponential growth when there's chaos? You're not going to get it from cash. You're going to get exponential growth or the opportunity to benefit from chaos from anti-fragile assets like inverse performing ETFs. David Moss is coming up a little bit later from Direction Investments, by the way. We'll be talking with him about that and much more. But those are the types of anti-fragile assets that benefit from chaos. Things like inverse performing ETFs. Things like VIX, volatility linked ETFs. Things like put options. These are things that don't just stay the same, but grow or benefit or gain. from chaos. So just keep that in mind when you see wealth funds stockpiling cash. Cash has a place, provides liquidity, it provides some semblances of stability. Of course, over the long run, cash has been, and will be a drag on portfolio performance because of this hidden thing called inflation. And also the fact that cash yields, relatively speaking, yields a much lower return compared to other asset classes. So keep that in mind. 800-516-1220 is the number if you'd like to join us. We're going to take a look coming up a little bit later after our chat with David Massa. He's warming up in the bullpen. We're going to take a look at a couple of relative weight ETFs, relative weight strategies, compare and contrast performance, a tale of two indexes and two indexing approaches and strategies. So stay tuned for that. Before David joins us, though, I just want to mention briefly about the whole idea of relative weight indexing. Of course, as we know that no single investment strategy works all the time. In fact, we talked about that on last week's program. That was the theme of last week's show. If you missed it, you can listen at our website, indexshow.com, or listen on our podcast feed at iTunes, Spotify, Google Play, YouTube. But we talked about how no single investment strategy works all the time. And so that's the real story and message behind relative weight indexing, because you're overweighting a certain strategy that may be in favor while underweighting another strategy that may be out of favor or not performing as well. And so Direction has a lineup of 10 relative weight ETFs that use this same strategy. They're all index-based, and they favor a certain investing style or approach over another. For example, Direction MSCI Cyclicals over Defensives ETF. It's ticker symbol RWCD. And then the opposite of that is the Defensives over the Cyclicals, ticker symbol RWDC. So which ETF will you choose? Well, it depends on your perspective. If you feel that defensive stocks is the place to be, you'd rather be defensive than in cyclical stocks, or what we might call consumer discretionary stocks, then RWDC would be the choice. In contrast, if you feel that, well, I think consumer discretionary stocks are going to continue to outperform as they have been, I think consumer spending is going to expand, and I'd rather be more aggressive than defensive, well, then RWCD is going to be the obvious choice. And so the way that they achieve this is they go long with 100%, 150% exposure and short 50% exposure. And that's how they get their net 100% exposure. But each relative weight ETF and its benchmark index has what we call an oppositely weighted counterpart. So you can take a position, as I just illustrated to you, in growth over value or value over growth. And so this just provides you an opportunity to be able to capture that spread or difference in performance over performance advantage of one strategy or one philosophy or approach over the next. And so we're going to talk a little bit more later. I'm going to give you a case study of two specific ETFs that run counter to each other. One emphasizes growth, the other emphasizes value. But we're going to take a look at how this has turned out in terms of performance and help you understand what it means. 800-516-1220 is the number. You're listening to the Index Investing Show. David Massa at Direction Investments is coming up next. We're going to talk about some of the important trends happening in the market. Also, I haven't mentioned it yet, but trade war, what that means for the market, and also ways to capitalize and even hedge your portfolio against some of the craziness surrounding us, politically speaking, geopolitically speaking. Again, this is the Index Investing Show. I'm Ron DeLegge. 800-516-1220 is the number. At Index Show is my Twitter handle. More when we return. Go nowhere.
Do you have an investing or retirement plan question? Tweet the program right now or follow us on Twitter at Index Show.
With more than 2,000 ETFs in the U.S. market, finding the right funds is more complicated than ever. ETFguide.com simplifies your life by sending you free guides on the top ETFs. Sign up at etfguide.com/snapshot. Choose from our library of free guides covering commodities, inverse, and leverage funds, along with new ETF launches. Our carefully screened ETF guides will save you time. Sign up at etfguide.com/snapshot.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
First quarter U.S. corporate earnings have been strong, but a trade impasse between China and the U.S. has the market on edge. Dave Massa, the head of product at Direction Investments, is with us. The company manages almost $14 billion in assets across a menu of leveraged and inverse ETFs, along with thematic weight ETFs. Dave, welcome to the program. It's great to have you with us.
Hey, thanks for having me today.
After a 4-month period of unusual calm, stock market volatility is on the rise, and usually stock market volatility is portrayed as something negative, but it can also lead to opportunities. So tell me, Dave, do you think investors should start reevaluating their opinion of volatility?
Well, I think you're absolutely right. We've been in a period, not just the past 4 months, but if we take a step back, really the past few years, where volatility has been abnormally low, and investors have really benefited from almost a set it and forget it approach if they were fortunate to allocate toward equities in the early part of that. But more recently, whether it's the potential impact that the trade policy will have, or simply the monetary policy questions that continue to emerge, I think investors would be best served to think about the impact that volatility could have in their portfolios and prepare for that in some way, shape, or form.
Dave Massa, head of product at Direction Investments, joining us. Now, industry sector standouts thus far in 2019 are technology and semiconductors, which are both outperforming the broader stock market. Two Direction ETFs targeting these sectors are ticker symbol TECL and SOXL. Both are bullish ETFs that use triple daily leverage and are up year to date despite the recent pullback. So tell us, Dave, what's behind the big move in tech stocks?
Yeah, well, we've seen semiconductors and the larger tech sector do extremely well as for a few reasons. One, investors in a low economic growth environment were really looking for the companies that were generating the most positive expected earnings growth, and semis really fit that to a T. But more recently, when we see a market pullback, those higher beta names, the higher momentum names like semis and tech, they're going to be the first to be impacted. So we've seen that pull back a bit as we have seen this last week volatility come to bear, especially due to the fact that it's coming less from a near-term economic impact, but what the potential larger economic impact could be based off of China trade policy. So our funds in particular, those that offer tactical traders the ability to gain enhanced exposure to them, have been of interest, not just heading into this most recent volatility event, but even through it, as investors maybe look for either this rhetoric to settle down or change market direction.
Go to directioninvestments.com to learn more about efficient, tilted exposure to the important big picture market trends right under your nose. Now, one of the most exciting thematic investments, I think, is a trend towards AI, also known as artificial intelligence. You've got automation and robotics, of course, part of this. We're seeing it with the invention of drones, driverless cars, which are on the horizon. And Direction introduced not too long ago an ETF linked to this very important investment theme. That's the Direction Daily Robotics, Artificial Intelligence, and Automation Index Bull 3X shares. That's ticker symbol UBOT. Tell us more.
Yeah, to your point, thematic investing is one of the most exciting areas in the market today because what they really do is take, not just as we think about sectors like technology or energy or financials companies, but really flip that on its head and say, what's the future sector or industry going to look like? And to your point, the robotic space is really one of those because of the vast applications that it can bring across the board to really transform not just the technology industry, but industries at large, whether or not it's drones delivering food or doing something in a unique way to provide better, improved medical services. And our fund was really built off of the premise of that, of giving tactical traders more 3 times exposure to that particular theme in the market, which we think, not just from investor interest, from a trading volume perspective or flow perspective, will continue to be more relevant and get more attention in the media. So I would really encourage investors to think about the themes that impact their daily lives, what maybe matters to them, and use that as an additional tool in thinking about what exposures they might want to introduce in their portfolios.
Dave Mazza, the head of product at Direction Investments, is with us. Now, some investors may like the idea of leverage, but not necessarily 200 or 300% daily leverage. So for this group, the 5 Portfolio Plus ETFs from Direction could be a good fit. Tell us more about how they work and how investors might use them.
Yeah, so more tactical traders, can really potentially see their portfolios benefit from using products that have amplified exposure at the 2 times or 3 times level. But for investors who have more of a longer-term strategic view, we created a series of, as you noted, Portfolio Plus products to provide slightly more exposure. So in this case, 135% exposure to a particular market for an investor who has a long-term point of view. Any of the potential downside that can come from compounding in volatile markets doesn't apply to as great an extent with these. And if an investor is saying, hey, I actually want to just be exposed to the U.S. equity market or the U.S. small cap market over the long run, and I want to have the potential to maybe accept a bit more volatility, but have improved and enhanced returns, a product which offers you just slightly more exposure in the market can provide you that benefit over the long run.
Now, Direction also has 10 relative weight index ETFs whereby an investor can overweight or underweight various segments of the stock market. So let's say, for example, I had a more cautious view about consumer spending because of the ongoing China trade war. How could I reflect that view, let's say in a single trade? Which of these relative weight ETFs might be a good fit?
Yeah, so let's give it a quick overview of what are the relative weight ETFs, because they're really a unique offering in the marketplace. And they're intended to allow investors to be able to express a particular view that a portion of the market is going to outperform another portion of the market over 6, 12, 36 months. So we have products that range from growth over value to value over growth to large over small, small over large, et cetera. But we also apply this to the international markets. So we have an ETF that gives an investor 150% exposure to the U.S., and it's 50% short international markets. So for an investor who is concerned about what the potential impact that tariffs could have in the market, they could tilt, or the U.S. market in particular, they could actually take that opposite point of view, take advantage of our ETF, RWIU, that gives you 150% exposure to the international markets with 50% short to the U.S. markets. But really the great thing about these is that they're really tools for investors to use in their portfolios, and we offer the reciprocal of each pair. So an investor may have a view that value is going to beat growth or growth is going to beat value, but that's up to them to make that particular decision.
Yeah, that's great. I was thinking about ticker symbol RWDC, the defensives over the cyclicals, but you're right. I think RWIU is another angle. If you're just joining us, you're listening to the Index Investing Show. We're pleased to be chatting with Dave Mazza at Direction Investments. Go to directioninvestments.com to learn more about the ETF investing. One last thing before you take off, Dave. Hedging allows people to protect their portfolio without selling investments and triggering trading commissions along with potential taxes. So say a stock-heavy portfolio be hedged using something like the Direction Daily S&P 500 Bear 1X shares, ticker symbol SPDN.
Yeah, it's interesting. Anytime we see bouts of volatility, we get more questions from investors about hedging. But really, it's something that I think in any market an investor should be thinking about, because volatility can rear its ugly head from time to time in unexpected ways. But more specifically to your question, we offer products that provide the inverse on a daily basis of the S&P 500, for example. So SPDN is the particular ticker, where on any given day, it's intended to provide the inverse of exposure to the S&P 500. And so what that means is, for an investor who wants to have an allocation or is looking to have an allocation to this, they need to be monitoring it on a daily basis to understand what particular exposure that they're getting. But it can be a great tool for them from an insurance policy perspective. Now, over the long run, we know that markets have a bias toward going up, which is a good thing that can help us generate wealth. But for someone who's looking to hedge their portfolio in a potentially less complicated way than having to use options or something of that nature, we think a one-time inverse product could be a tool that they should be thinking about considering, knowing that they're going to have it be actively monitoring it, just like they would with any other short-term investment.
Dave, thanks for taking the time. Some great ideas. You just heard again from Dave Massa at Direction Investments. I'm Ron DeLegge. This is the Index Investing Show. More when we return. Be here or be nowhere.
You're listening to the Index Investing Show with Ron DeLegge. Subscribe to our podcast at iTunes, Spotify, or Google Play. Be sure to leave a review.
800-516-1220 is the number. At Index Show is my Twitter handle. So much to talk about, never enough time. And if you want to learn more about investment portfolio construction, how to manage your own investments, or you're looking for something to educate your own financial advisor about with pertaining to your own investments, maybe strategy-wise, how to construct a portfolio the way that you want. And of course, the framework that we teach on this program is a 3-container framework: core portfolio, non-core, and then your margin of safety. Those 3 components make up your total portfolio. You can go to indexshow.com, click on online classes, and you can enroll in any one of my 4 online classes, which will give you a framework for achieving the type of results that you deserve. And so, again, indexshow.com and click on online classes. Coming off an interview there with David Massa at Direction Investments. We talked about a lot of things in that interview. One of the things that we discussed was relative weight index ETFs, and this is rather a newer strategy or idea in the indexing world and in the ETF landscape. The whole idea, again, is to overweight certain strategies relative to others. So, for example, if you want to overweight emerging markets over developed markets, you'd go with ticker symbol RWED. If you said, listen, I want to invest in international stocks over U.S. stocks, I think that's going to be where the better performance comes, because right now U.S. stocks have outperformed international for quite some time. But I think that trend is going to change. And actually, I think there's more value in international stocks because they've underperformed. So for that reason, I'm going to go with something like ticker symbol RWIU. So this allows you to capitalize on the spread or the difference, hopefully an outperformance from what you're overweighting. Now, just to give you an example, return scenario example of how this works. As I indicated, the long exposure is 150%. The short exposure is minus 50%. The net exposure is 100%. So let's just take a look here, and as an example, let's say that the long component of your relative weight indexing strategy, the long component is up 10%. Let's say that the short component is down 5%. Well, you got to blend the return which would be the final return in that scenario would be positive 17.5%. So that would be return scenario 1. Return scenario 2, if your long component is up 10% and your short component is up 5%, the direction relative weight index ETF should be up 12.5%. So again, this is just an example illustrating how the return scenario component would work, because you've got two moving parts inside these relative weight index ETFs. You've got a long component, which is long 150%, and then you got a short component, which is negative 50%. So when you have to blend out the final return, and depending on how each one of those components performs. Now let's just take a quick illustration and example, kind of a case study of how this has worked out this year. So let's just take a look at, just for example, small cap stocks. So the Russell 2000 index, ticker symbol IWM, that's the iShares Russell 2000 ETF. Again, that follows small cap stocks, U.S. small caps. It's up almost 5% since the start of the year. But what if you took this relative weight indexing strategy and you said, listen, I want to focus on the growth stocks within the Russell 2000. I don't just want to own the entire group, but I want to own the small cap growth segment. And I think that small cap growth segment, by the way, is going to do better than value. Well, ticker symbol RWGV, that's growth over value, is up 9.5% compared to the regular Russell 2000 ETF, which is up, like I said, just under 5%. So you've done better emphasizing growth over value. And then the other ETF that emphasizes the opposite, which is value over growth, has actually lagged because the value component has been performing at a much slower velocity compared to growth in 2019, and it's up only about 3.25%. So again, this is just a case study, a very small case study, with taking a look at U.S. small cap stocks of how you can emphasize in your investment strategy certain segments of the market with like drilling down and real narrow focus, which I like, and I think within the context of your non-core investment portfolio is absolutely fine to do. That, in fact, that's the right context, and the right approach is to do it within that context, that setting, so as to get the precise exposure that you want, that reflects your precise opinion or view of the market. 800-516-1220 is the number. At Index Show is where you find us on Twitter. A couple of other things on our Twitter feed. Some guy by the name of Steve Burns is complaining about taxes being really high. I think I may have touched on this last week, but I'll mention it again. He says you've got income taxes, you got capital gains taxes, you got sales tax, you got property tax, you got inheritance tax. He's complaining about all these taxes. My comment is this: is U.S. income tax rates, Steve, and for the rest of us, are at 80-year lows, and we're complaining about high taxes? Are you kidding me? Taxes are not high relative to where they've been in the past, and they're going to be this low up until 2025, when the current legislation that was passed in 2017 expires. And so you've got between now and the year 2025 to take advantage of historically low tax rates here in the U.S., income tax rates. They've never been this low in 80 years. And so how do you do that? As I've been saying on the program, and I will continue to proclaim this message, Roth IRAs, Roth 401ks, make contributions. And also for those of you that have too much money in your IRAs and your 401k plans that are just before 70 and a half, before those RMDs start kicking in, take a look at doing some Roth IRA conversions. Get your money out of the tax deferred bucket into the tax-free zone. Well, that does it for another episode of the Index Investing Show. Be sure to listen to the program at indexshow.com. You can also listen to us on Spotify as well as Google Play and YouTube. And until we meet again, may the market indexes be with you.
Thank you for listening to the Index Investing Show with Ron DeLegge. Connect with us on the web at indexshow.com. And be sure to subscribe to our podcast at iTunes, Spotify, or Google Play.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.